Good afternoon, everyone. Thank you for all joining us today. My name is Jimmy Bassett, and I am a managing advisor at Altfest, and I will be the moderator for our presentation today. For today's presentation, we'll be looking at some tax planning and tax reduction strategies. I'm sure this topic is on a lot of people's minds as today is quickly approaching our April 15th tax filing deadline. Also, given the proposed legislation that has been continually circling around Congress, I think it's a timely discussion where we can lay out some of the strategies that we are currently utilizing for you. Now, I'd like to introduce today's presenter, Jessica Nelson. Jessica is a CFP, CPA, and a financial advisor at Altfest. And prior to joining the firm, Jessica was a senior tax accountant at Deloitte, dealing with tax returns for high net worth individuals. Now, most of you attending today are Altfest clients, but I do believe we have a few guests in attendance, so I do want to quickly provide a quick background on our firm and who we are. We are a comprehensive financial planning and investment management firm, and as fee-only fiduciaries, we take an objective approach in guiding our clients by helping them achieve peace of mind with respect to managing all aspects of their finances. We accomplish our mission by taking a holistic approach, integrating thoughtful investment management with comprehensive financial planning. And we work with our clients on an ongoing basis throughout different stages of their lives, adapting our approach to our clients' ever-evolving needs and circumstances. Now, before passing along to Jessica, I do want to mention that we will finish with a Q&A at the end of the presentation today. If you have a question during the webinar, please click the arrow on the webinar box on the right-hand side of your screen, and a chat box will appear. Feel free to submit your questions there. We will do our best to answer all of the questions that we receive during the webinar. However, if we do not get to your specific question, we will follow up with an email response. And so with that, I will turn it over to Jessica Nelson to begin the presentation.
Thank you, Jimmy, and thank you all for joining our conversation today. So like Jimmy said, right now we're in the middle of tax season, right? So I'm sure this is a topic on many of your minds. So if you go to the next slide, we'll just give you an overview of what we'll be discussing today. We're going to talk over some tax-efficient portfolio management strategies, some tax savings ideas around charitable giving, as well as retirement plans, as well as some business owner-specific strategies. So if we dive right into it, the first topic we're going to go over is tax-efficient portfolio management. Now, many times when we're thinking about our portfolio, we're thinking about how to structure it in order to meet our long-term goals, right? Whether that be retirement, whether that be a house purchase, many other goals, right? But too often what is overlooked is the impact that taxes have on your portfolio. And for individuals who are higher earners, who are in higher tax brackets, this can be a very severe impact. In fact, by implementing some of these efficient portfolio management strategies, you can greatly impact your after-tax returns. So if you go to the next slide, one of the most probably easiest but very important strategies to keep in mind is diversifying your account type. So what does this mean? We want to make sure we fill all of our buckets. We want to have our taxable assets, we want to have our tax-deferred assets, and where possible, we want to have our tax-exempt assets. So when we're thinking about tax-deferred assets, what we're talking about is our retirement plans, right? So our 401ks, our 403bs, our IRAs, and things of that nature. So when we're talking about these type of accounts, we usually have two options. We have Roth, being post-tax contributions, and we have traditional, being pre-tax contributions. So just to give, to make sure we're all on the same page, to give a brief overview, what traditional assets are is when you contribute to your account on a pre-tax basis, meaning you contribute now and you essentially get a tax deduction for contributing to that. The funds go into your account, they grow tax deferred, and when you pull them out during retirement, you then have to pay taxes. Now with Roth, these are post-tax, meaning you pay taxes now. When you contribute now, you do not get a tax deduction. You go ahead, you contribute, that account grows, but when you take those funds out, then there's no taxes owed. So often what we get asked is, which one should we do, right? Especially when we're working with some of our younger professionals. This is a very hot topic. So here we have a graph that shows an individual over their career lifespan, really, right? And what we're seeing here is in this lower half, this lighter blue, that's when this individual is at their lower tax bracket. That's when it makes sense to do Roth. Now, if we go up to that yellow, that light yellow, this is when they're at their highest tax bracket. That's when it makes sense to do traditional. So let's look at this individual. This individual is 25. Maybe they just graduated from college. They're off to their first job. And at this point, it's safe to assume that they'll be at one of their lower tax brackets that they will ever be in, right? So if we fast forward a few years, maybe, they're doing really well, they get a big promotion, and then they start getting larger bonuses, and now we're looking at being at one of the highest tax brackets that this person may ever be in. So at that point, we would want to switch from Roth to traditional. And as you can see here, this goes up and down, right? And this is why it's essential that you're working with your advisor to talk about what's going on in your life and how we can contribute to these accounts in the most tax efficient way. Now, if we fast forward a few years, now this person is 60. And since then, they have gotten married, which impacted their tax bracket. They opened up a business, many things have happened. But at 60, they're decided to retire, both them and their spouse. Now, since they're retiring early, they haven't started collecting Social Security yet, and they haven't started their RMDs, those required minimum distributions. So their income is very, very low, right? And at that point, we may want to start thinking about Roth conversions. So what are Roth conversions? This is when we take our traditional assets, we pay taxes on it and convert it into Roth. So if we go to the next slide, we see an example of how this may play out. So here's an individual who is age 53. They're considering converting $100,000, and their current tax bracket here we see is 35, and their long-term capital gains rate is at 20. So if we go to the next slide, we see how this plays out. So here on the graph, we see in this blue converted assets, and in this orange, the non-converted assets, if they chose not to convert. So as we can see from this chart, around age 85 or so is where they have this break-even point, right? Where the conversion kind of, breaks even, and then at that point, we have some value added. In fact, over this person's lifespan, this Roth conversion had a total value added of almost $200,000. So why would we do this, right? We would do this for that value added, and maybe we're using this Roth conversions during the latter years of your retirement. Or if legacy planning is important to you and you're thinking about ways to pass on tax efficient assets to your heirs, Roth assets are great for that. In fact, for many of our clients, we'll manage the Roth assets a little bit different depending on what their goals are. In addition to thinking about maybe when you're retired and doing those Roth conversions, then we also want to think about what throughout the years, what opportunities we may have for Roth conversions. So an example of this would be when RMDs were suspended. Roth conversions was something that we did with many of you, right? Or if your business is having is having a slower year. So again, I just wanted to reiterate, wherever possible, we really want to be keeping your advisor in the loop as to what's happening. If you go to the next slide, I now want to move on and talk about the benefits of having a defined benefit plan in conjunction with having a profit sharing plan. So what are these? A profit sharing plan is like your 401k, right? It's something that both you and your employer are contributing to, while your defined benefit plan is also a retirement plan, but the goal with a defined benefit plan is, as it states, to have a specific benefit during retirement. So maybe you're targeting a certain amount annually, a certain amount monthly, right? And this is something that a lot of business owners have the opportunity to implement for themselves, and it allows them to contribute more to retirement accounts. So as you are the employee and the employer, you're able to contribute for yourself for this account. So here we have an example of an individual who only contributes to the profit sharing plan versus someone who has both. Now, for the individual who only contributes to the profit sharing plan and not to the defined benefit plan, then their option is to contribute to an after-tax account instead. Now, for both of these individuals, we're looking at a period of 12 years. We're looking at investment returns of 6%. However, the person who has both the profit sharing plan and the defined benefit plan end up with tax savings of a little over $3.6 million. And this is a pretty significant number. So for any individual who is a business owner, for a lot of our dentist or physician clients, we highly encourage you to talk to your advisor and see if this is something that makes sense for you. If you go on to the next slide, I now want to shift a little and talk about the importance of asset location and not just asset allocation. So we've kind of all been beaten over the head with the importance of asset allocation, right? We're constantly telling you how important it is to diversify your investments, make sure that your asset allocation, your mix between equity, fixed income, alternatives is something that you're comfortable with from a risk perspective, but it's also something that's going to help you achieve your long-term goals. Now, something that we find isn't often talked about enough is actually your asset location. So once you created this beautiful asset allocation, where are we putting these things, right? What accounts are these investments going in? So this goes back to those different buckets: your taxable account, your tax deferred account, and your tax exempt account. So let's take a look at an example and think about fixed income, right? So let's think about tax-free municipal bonds. So with tax-free municipal bonds, if we could just go up one slide, with tax-free municipal bonds, this makes sense for our clients who are in the higher tax brackets, right? Because of the tax-exempt benefits for it. However, if you're a high earner and municipal bonds make sense for you, we're not going to put that in your IRA, right? We're going to want to make sure that that's in your taxable account so that you're getting the advantage of those tax advantages, right? It's almost redundant to put something like that in your IRA. Now, if we're looking about taxable bonds, that's something that maybe we wouldn't want to hold too much in your taxable account. It may make sense if we do want to diversify each account as well, so maybe we put a little bit more in some of your tax deferred accounts instead, or your tax exempt accounts instead. So this is something that we're constantly looking at when we're building out our portfolios. It is worth saying that even though we want to think about tax efficiency, when it comes to portfolio management, we have to keep the ultimate goal in mind. And the ultimate goal in mind is making sure that you have the appropriate returns to satisfy your needs. So right now, if we're looking at municipal bonds, you may notice that that's not something that we're really purchasing any new municipal bonds, right? Because we think that they're not as attractive at this moment. Maybe we can get some of the benefits that we usually look for bonds for. Maybe we're focusing a little bit more with alternatives. So while tax efficient portfolio management is very, very important, we want to make sure that we don't get distracted by the benefits of taxes and sacrifice the performance of your portfolio. Now, if we go to the next slide, the next topic we want to cover is managing capital gains and losses. So if we're thinking about that taxable account, right, we're going to be trading this. We're going to have some events where we have some capital gains and losses. How do we manage this? So often when we're thinking about losses, there's a negative connotation to this. We don't want to see losses, but it's a reality, right? In fact, losses are actually an opportunity and should not be shied away from. So here we have a graph that shows a hypothetical security throughout 2019 that experienced some volatility. So from around February to August, we're seeing here that there was an opportunity for loss harvesting. So this is when you sell the security at a loss and then use those losses to offset any other capital gains you may have. What's also great about capital losses is $3,000 of that can actually be used to offset other, earned income, and whatever is not used, you may carry. When do we want to do this, right? When do we want to start thinking about tax loss harvesting? So we do this throughout the year. In fact, right now, with the markets being volatile, we may look at someone's portfolio and say, hey, is there any tax loss harvesting opportunities here? Or let's say you're at a position where you're reconsidering some of your investment strategies. You're reconsidering whether certain holdings are appropriate for you or not. Maybe it's okay to go ahead and restructure some things, harvest those losses now so we can use that to offset any future gains that we may have. Now, what about those gains? What do we do when we have to, when we're dealing with that? So here we have a chart of two different portfolios. They're both start at $1 million, have a 6% annual return. However, one is deferring capital gains and the other is recognizing. So this light blue that we're seeing is an individual whose gains are being realized annually, while this green, is someone who is deferring their capital gains. And as you can see, the person who's deferring their capital gains, they're ending up with a value of about $3.2 million, while the person who is recognizing them, who's realizing these gains, is ending up with 2.5. And this because by deferring those gains, one, you get to recognize capital gains at the long-term rate, which are preferential. Long-term capital gains rates are 0, 15, and 20%, depending on your tax bracket. But also, in addition to that, since we're not doing this every year, we just get to, the more time we have in the market, the better. So because we're not recognizing gains every year, we're deferring those taxes. Now, with that said, there are times where it may make sense to go ahead and recognize those gains. And you're like, what are you talking about? You just said to defer them, right? But I think about what some of you may have thought in your portfolio towards the end of last year. So there were several funds that we were holding that had estimated high capital gains distribution, right? In which the mutual fund were going to distribute the capital gains to you, to the holders. Now, some of those were actually short term. So we took a look, and we did this on a case-by-case basis, and we compared what the tax consequence was going to be if our clients were to sell those positions, recognize in some cases a short-term gain from that, versus if they were to hold that, receive that capital gain distribution, and have to recognize the short-term gain on that capital gain distribution. And what we found was, for a number of our clients, it actually made more sense for them to go ahead and sell that, recognize the gain from the sell, rather than having to recognize that capital gain distribution. So this is just one of the things that we're constantly looking at to make sure that we are managing your portfolio in the most tax efficient way possible. If we go to the next slide, now I want to go into some other tax savings ideas. So the first one on the next slide relates to that tax exempt bucket that I mentioned earlier. So you may think, like, whenever is there tax exempt money, right? The IRS makes sure they tax everything. Well, with the health savings account comes a very unique opportunity. So a health savings account is an account that individuals who have high deductible health plans are able to contribute to. So the idea is you have this account and you're using it for qualified health expenses. However, you are not required to use the amount that you put in annually. You know, it's not the same thing as a flexible as a FSA. This is a HSA, which allows you to put the funds in and actually invest the funds that you're putting in. You don't have to use up your balance every year. So you're able to go ahead and contribute to it. Once you contribute, we actually have a tax deduction for contributing to it. You invest the funds in here, it grows, and when you're ready to, you have a health event and you need to withdraw from that, if you're using this for qualified expenses, you actually don't have to pay taxes on that. So this is an amazing opportunity to save, and we often tell our clients to kind of use this almost like as retirement savings, right? Think about what your health expenses are going to be in retirement, and you would use this bucket for that. So here we have an example of someone who is 40, and they plan on maxing out contributions until they are age 65, which is when they plan to retire. So we assume that the investment return in this account would be 5%. Currently, this person's marginal tax bracket is 32%, and then after retirement, it will be 25%. And they're going to be withdrawing $2,000 annually. So we have total tax savings for this person of around $500,000, which is very, very significant. So if you are someone with a high deductible health plan, if that makes sense if that's available to you and it makes sense for your health situation, this is definitely something that we would encourage you to do. In fact, you can send your employee benefits plan to your advisor, and they'll be more than happy to discuss this with you. If you go to the next slide, now I want to talk about some opportunities for gifting, right? So for some people, it is important that you are donating to charity. And as you may know, donations to charity can be tax deductible. However, with the Tax Cuts and Jobs Act, we saw an increase in the standard deduction, which means a lot less people were itemizing. Therefore, a lot of people were not getting the benefits of donating to charity. So for this section of the presentation, we want to talk about some ways to optimize your gifting strategy. And the first one being is donating appreciated securities instead of donating cash. So what's great about donating appreciated securities is that the amount you're able to claim, that deduction amount you're able to claim, is the fair market value of that security on the date of donation. So this is a great strategy if you have appreciated securities, because you went in, you purchased this at a given cost basis. Here we have an example of $1,000, but currently, let's say your fair market value is $5,000. If you were to sell this, and you're subject to the long-term capital gains rate of 20%, as well as the net investment income tax of 3.8%, you would have to pay $952 in taxes, right? And if this was something that you were thinking of giving to charity, then your charitable contribution is less. Then it's a little over $4,000. Now, vice versa, if you were to donate this instead, you would have to pay no long-term capital gains tax. You have to pay no investment income tax on this, and you get to deduct that full $5,000. So for clients who have maybe a lot of legacy positions, a lot of individual holdings, this is something that we are constantly suggesting. If we go to the next slide, we'll talk about how to layer this strategy with a donor-advised fund. So what is a donor-advised fund? This is an account that you would set up whose sole purpose would be to donate to qualified charities. So with a donor-advised fund, I can donate to that fund, and then that fund will then distribute to several different charities. And you may ask, like, why would I want to do this? So let's say I'm in a high tax year, right? You made a lot of money, your business is doing great, maybe you had a large bonus. So you want to make sure that you're having higher itemized deductions this year. So you go ahead and you front load this donor advised fund. You contribute a large amount. However, maybe you don't want to distribute that amount to charities right away. Let's say you have a school that you usually donate, let's say $5,000 to. You still want to keep that. You don't want to go ahead and give them that lump sum. This is where a donor advised fund come in, right? Because I can go ahead and I can put all of my contributions to that this year, claim all of that deduction this year, but then my donor advised fund can extend the donations to the charities over a course of several years. So if we're looking at this example, this individual is contemplating either donating stock directly or donating that stock to a donor advised fund and doing just that, doing the annual donations of $5,000. Now the person who donated the stock to the donor advised funds has tax savings of almost $20,000. And the reason for that is they were able to get all of the benefits from that donation, right? Instead of just doing these $5,000 every year, not having enough to take advantage of that full itemized deduction, they front load it. In 1 year, they had that large itemized deduction. And maybe in subsequent years, they went ahead and took that standard deduction. Now, if you go to the next slide, we'll talk about some other strategies that are available to you. So if you are someone who are 72 or over, and you have to take R&Ds, what you can actually do is from that R&D amount, donate to charity. So this is referred to as a qualified charitable distribution. So each individual is able to do QCDs up to $100,000. What's great about this is this counts as towards your RMDs. However, it reduces the amount, it reduces your taxable income. And this is like a dollar for dollar benefit. So it's very, very powerful, especially for married filing jointly couples, because it's $100,000 per person. So together you can do up to $200,000. Now, this is something that we are often talking to our clients about, and if this is something that you are interested in, please reach out to your advisor to discuss. Another item that I really wanted to mention is that this year we do still have that above the line charitable contribution. So if you're someone who takes the standard deduction, but you still donate some amount to charity, you can actually claim up to $600 for marriage filing jointly of that in addition to your standard deduction. So if that was you and you haven't done your taxes as of yet, please make sure that you are talking to your tax preparer about this. If you go on to the next slide, I now want to get into some business owner strategies. So if you go to the next slide, the first one, and possibly the most interesting and creative, is being able to employ your children in your business. Now, in the United States, we have child labor laws, right? And this restricts the age that children are allowed to work, and possibly even when they are, the amount of hours they are allowed to work. Now, for individuals who own their own business, they actually have an exemption from these child labor laws. So you are allowed to employ your children. And if you're a sole proprietor, a single member LLC, or a partnership where both parents are the only owners, you're able to hire your child, and they may not be subject to FICA and FUTA tax, depending on their age. So this is a very, very unique opportunity. There's not many times in our lives where we can work and pay no taxes. So if this is something that's available to you, we highly encourage you to consider hiring your children in your business. And to even add on to this benefit, what you can then do is open up a Roth IRA for your child. So as we discussed earlier with Roth IRA, those are post-tax contributions. However, if your child is not subject to taxes, then they would have a rate of basically 0%, right? So they will go ahead and pay that $0 in taxes, then contribute to their Roth. It will grow. It would be there for them, and when they reach retirement age and they're ready to draw from that, they're also paying no taxes. So this is benefits all over. This is a benefit for your business because this is a legitimate expense, and you're able to deduct wages. It's a benefit for your child, both now and during retirement. It is worth noting that for children, the way that kiddie tax works, they are entitled to the same standard deduction that single people are. So if they have a salary that is higher than that standard deduction, then they will in fact have to pay taxes. So you want to keep that in mind. You also want to keep in mind that their wage has to be reasonable. So we can't pay someone $15,000 to not do much work, right? We want to make sure that their wages is in line with what they're doing. Additionally, an interesting case that I read not too long ago was a parent actually tried to claim support for her child as wages. She said she hired the child in her business and she paid him with care. And that does not count. So we want to make sure that we're working with a CPA in order to implement something like this. So if we go to the next slide, the next opportunity that I want to talk about for business owners is the pass-through entity tax. So with the Tax Cuts and Jobs Act came the state and local tax deduction limitation. So prior to the Tax Cuts and Jobs Act, you were able to deduct all of your state and local taxes paid on your federal return as part of itemizing deductions. However, that has been capped. And for many people in states like New York and New Jersey and, just other states that have high income tax, this was something that was really impactful for them. They were losing out on all these deductions. So what states like New York did was come up with this elective pass-through entity tax. And what this does is allows your pass-through entity to withhold state taxes on your behalf. So the way this would work is your entity, let's say it's your S corp, would go ahead and withhold those taxes for you. And then the K-1 that it then distributes to you would be net of those taxes. Therefore, the income you're reporting on your federal return is reduced, right, for those withholdings. Therefore, you're essentially getting a deduction for your state taxes and completely bypassing that SALT limitation. It is worth noting that for New York, this is only applicable for state taxes. So if you live in New York City, your entity would not be able to withhold New York City taxes on your behalf. You would still have to, do that as you, as the individual, not the entity, and you would still have to go through that SALT limitation. But it is still a very powerful tool to use. So if you're a business owner, I highly encourage you to talk to your tax preparer and see if this is appropriate for you. Now, if you go to the next slide, at this point, I want to pass it over to Jimmy, who is going to lead us into our Q&A.
Thank you very much, Jessica. And as I mentioned before, we do have a few questions that have come through, but if anyone else would like to ask us a question while we have a few minutes left, you can click the arrow on the webinar box on the right-hand side of your screen and enter the question in a chat box. So we will see if we can get to all of our questions that we have today. To start off with our first question, Jessica, we had one come through that says, how do I balance deferring gains with managing low cost basis?
Yeah, absolutely. That's a great question, because early in the presentation I mentioned that where possible we may want to defer gains as much as possible, right? And that results in having that lower cost basis. So what we want to do with securities that have some of those lower cost basis is we want to donate to charity where possible, right? That's where we're gonna go ahead and donate those appreciated securities, avoiding those capital gains tax.
Thank you. All right. Next question we have is going back to what you were talking about before with Roth assets. How can I build up Roth assets if my AGI is too high to contribute to a Roth IRA directly, and it makes more sense for me to contribute to the pre-tax employer plan that I have?
So there are many options for doing that, and one of them is the backdoor Roth. So with IRAs, there is, if your AGI is too high, like the question mentioned, you cannot contribute to Roth IRAs. However, there is no AGI limit to contribute to a traditional IRA. There is a limit for the deduction, right? So if your AGI is too high and you contribute to a traditional IRA, you won't get a tax deduction for it, but you are able to contribute. So what you would then do is contribute to that traditional IRA. You won't get that tax benefit for it, but you're going to turn around and immediately convert that to Roth. It is worth noting that there was some proposed legislation late last year that would eliminate that. Nothing has been passed so far, but that is something to keep an eye on. Another option is considering those Roth conversions. So if it makes more sense for you to go ahead and contribute to your traditional assets now, let's go ahead and do that. But as we reach and get closer to retirement, once we're in retirement or when we're seeing those years where you have lower taxable income, then we want to start considering Roth conversion.
Great. No, that sounds very good. Thank you. Let's see, one last question that we had come in, I think this is the last one we have for right now, is actually a question regarding ETFs. So the question is, I've heard there's, or ETFs described as a more tax efficient investment than compared to mutual funds. Could you explain a bit about this? I think you know a little bit about this, Jessica.
Yeah. So you're absolutely right. We often hear that ETFs are more tax efficient, right? And the reason that sentiment exists is because of the way ETFs are managed. The way that they're managed, there's a lot less taxable events that are happening on the back end, which means that you're likely to see less capital gain distributions and things of that nature. So because of the way ETFs are managed, there's less tax consequences just by holding them. It is worth noting that when we're building our portfolio, we want to make sure that we're not just thinking about tax consequences, right? We want to think like, hey, does this position make more sense as an ETF, or is there value added by having a mutual fund? What I will also mention is that sentiment of ETFs being more tax efficient than mutual funds really comes from the way ETFs has traditionally been handled. Now that we're seeing a lot more actively managed ETFs, we'll see if that sentiment still holds up, right? I hope that answers your question.
Oh, absolutely. No, thank you. We did have one more question come through just recently. The question about asking about does executing a conversion trigger a taxable event? So I believe this is in reference to Roth conversions, maybe even potentially like the backdoor Roth option.
Yes. So doing a Roth conversion is a taxable event because what we're doing is think about it as almost we're pulling the funds out of that traditional and we're moving it over to the Roth. So that is a taxable event. So when you're doing a Roth conversion, you do pay the taxes that year. And this is why we want to make sure that when we're doing Roth conversions, one, we're very strategic about what we're then investing in. Does it make sense? We want you to work with us when we're doing these Roth conversions. We don't want to just tell you like, hey, do a Roth conversion and you go out and do it. Like, let's work together to make sure that this is happening and in an efficient way. We're doing it with the right assets and that it makes sense for you long term. Now, when we're thinking about a backdoor Roth, if we're doing this correctly, we won't have a taxable event, right? And this is very nuanced because it's important that we're thinking about what other assets you may have. So let's say you have a traditional IRA outside of maybe, let's say, your 401k or 403b and things like that, then doing a backdoor Roth may come with significant tax consequences. So this is a very nuanced thing.
No, I appreciate that. Those are some very good points that have come through. Now, I think that's all the questions that we've come through, and we are coming up right around the 45-minute mark. So I do just want to, again, thank you, Jessica, for everything that you were able to go over today. I think it's something that is, again, very timely and very helpful for our clients. If there are any questions that any of you have had today during the webinar that you did not get a chance to ask or come to you right after, please feel free to follow up with your advisor. During this time of year, we're fielding a lot of tax questions in general. We're happy to talk about some of the topics that we discussed on the presentation today. But I think for now, I just wanted to thank everyone again for attending. I hope you got something good out of this, and please take care and have a good rest of your day. Thank you.
Thank you.